Hi, Gary DeWaal here, and this is another version of Bridging the Week, October 21st to 25th, and today is October 28th, 2013. Good morning. The big news in the financial industry last week was the announcement that the US Commodity Futures Trading Commission this week, on Wednesday, October 30th to be exact, will be having an open meeting on its proposed rules related to the protection of customer funds at futures commission merchants and designated clearinghouses. You will recall that the CFTC had proposed requiring futures brokers to maintain in customer accounts as residual interest an amount at least equal to margin calls required to be paid by customers but not yet paid, although there was every expectation such calls would be paid fully and timely. Many industry participants, including customers, have argued that this requirement would actually hurt customers, not help them, because FCMs would require customers to maintain more funds at FCMs in advance of trading. This would expose the customers to a greater risk if their FCM failed. It is important to see where the CFTC finally comes out on this, and you can be sure I will report on it here next week. However, this past week, there were also some other important developments impacting the financial industry worldwide that are worth discussing. First, on October 21st, the US National Futures Association issued a member responsibility action against Alphametrix LLC, requiring it to repay $600,000 of advisory fees that it had deducted from commodity pools it operates and that were required to be reinvested in such pools, but were not. If Alphametrix does not repay this amount by close of business November 1st, it will be prohibited from placing any trades for pools it operates, except for liquidating trades, or dispersing or transferring any funds from any customer or pool account without NFA prior approval. You will recall that previously on October 10th, Alphametrix Group, the parent, had advised its customers that it had sustained, quote, significant cash flow issues, end of quote, and it fired its chief financial officer as a result. The parent company volunteered at the time that it had withdrawn management and incentive fees from various pools, but not paid those fees to the relevant third-party money managers. Alphametrix is registered with the CFTC as both a commodity pool operator and a commodity trading advisor, acts as a CPO of approximately 90 active pools, and had $700 million under management as of August 31st of this year. On November 26th of last year, a subsidiary of Alphametrix, it announced that it was chosen by NFA and the Chicago Mercantile Exchange to provide certain data aggregation services to help the regulators keep track of customer funds at depositories by futures commission merchants. Boy, doesn't that seem ironic now. It seems curious to me that Alphametrix has been given 21 days since its initial announcement of its problems to get its house in order. But let's see whether they can meet even this relaxed new deadline by the NFA. In a vivid reminder that it's not permitted to give any type of monetary incentives, directly or indirectly, to foreign officials for the purpose of influencing their acts or decisions to obtain or retain business, two companies were charged by the U.S. Securities and Exchange Commission last week with violating the Anti-Bribery and certain other provisions of the Foreign Corrupt Practices Act. This was in connection with their alleged efforts to secure and retain certain lucrative overseas business. In connection with one matter, the SEC charged DeWaal's Inc., a global provider of automated teller machines and bank security systems, with violations of the Foreign Corrupt Practices Act for, quote, lavishing international leisure trips, entertainment, and other improper gifts, end of quote, on certain foreign officials to help obtain and retain business with government-owned banks in China and Indonesia, and for paying bribes in connection with the sale of ATMs to private banks in Russia. The value of the illicit payments in these countries from 2005 through 2010 was approximately $3 million. In a second action, the SEC also charged Stryker Corporation, a US-based medical technology company, with various FCPA violations because of illicit payments from 2003 through 2008 of approximately $2.2 million US dollars made by its subsidiaries in Greece, Mexico, Poland, and Romania. These payments were described as legitimate expenses in the company's books and records for consulting and service contracts, charitable contributions, travel expenses, and commissions. The CFTC issued its annual summary of enforcement actions brought during the fiscal year 2013. Last year, the Commission filed 82 actions and obtained approximately $1.7 billion US dollars in monetary sanctions. And yet they still had to take a bunch of days off in early October because the government ran out of money. In addition to highly publicized cases involving LIBOR and other interest rate benchmarks, and enforcement actions against MF Global and Peregrine Financial Group, the CFTC filed and settled 14 actions against future commission merchants related to violation of customer funds protection requirements. In conjunction with the UK Financial Conduct Authority, the CFTC also filed its first enforcement action for spoofing against Panther Energy Trading and Michael J. Kosia, algorithmic traders, under the new disruptive trading practices prohibitions under the Commodity Exchange Act. I can't say the CFTC has provided one of those favorable strolls down memory lane, but check out the valuable lessons learned paragraph on the article version of this Bridging the Week section to see how I recommend that firms take advantage of the Enforcement Division's largesse in providing this summary. The SEC also brought enforcement actions against 3 investment advisors that previously had been warned by it about compliance deficiencies following compliance examinations, but failed to take satisfactory rehabilitative actions. The firms involved were Modern Portfolio Management, Inc., Equus Capital Advisors, LLC, and Equus Partners, LLC. Each firm agreed to pay financial penalties and retain compliance consultants in order to settle their matters. Not so smart not to act on friendly advice of the SEC, even if it's not so friendly. As I mentioned earlier, the CFTC announced this week that it will hold a public meeting regarding its customer funds protection proposals on October 30th, as well as regarding its proposals related to the collateral counterparties to uncleared swaps and ownership and control reports. The following week, on November 5th, the Commission will hold another open meeting to discuss proposed position limit rules for derivatives, including aggregation requirements. A federal court had struck down the last version of these rules during September 2012. Stay tuned regarding matters covered at these open meetings. On October 24th, the Federal Reserve Board proposed a standardized minimum liquidity requirement for large and internationally active banking organizations, as well as for systematically important non-bank financial companies as identified by the Financial Stability Oversight Council. These entities will be required to hold minimum amounts of high-quality liquid assets that can be converted easily and quickly into cash, such as central bank reserves and government and corporate debt. The amount of liquidity would have to be equal or greater than an entity's projected cash outflows minus its projected cash inflows during a short-term stress period. Comments on the proposed rule will be accepted through January 31st, 2014. The board claims its proposed liquidity coverage ratio is consistent generally with requirements under Basel III with some modifications, such as having a shorter transition period and more stringent requirements, including the type of assets that will qualify as high-quality liquid assets. U.S. firms will be required fully to comply with the new rules by January 1st of 2017. Well, we are out of time here, but there are a lot more stories covered on the article version of Bridging the Week. Check it out on my website. Until next week, this is Gary DeWaal, and this is Bridging the Week. Have a great week.